Welcome to today's episode of the Wealth Multiplier Podcast. My name is Laurent Meunier from Safe Pacific Financial here in Vancouver, Canada. And on the podcast today, we've got a very special guest, Vince Cardella from Pro Merita Strategic Wealth. Vince is a legend in the industry and will be sharing with us a ton of information that's very valuable and relevant for our clientele and for you who are watching. And this is going to include a brief history of insurance, details about Canada's life insurance industry being a key pillar of our economy, talking about generational capital gains, and the problems that life insurance helps to solve. We're also going to be getting into the key reasons that business owners get life insurance. We're going to talk about a little bit the benefits of insured annuities, which you don't hear about a lot. And you're going to get we're going to talk about how today you are younger and healthier than you'll ever be, and it's a good time to start making decisions and getting permanent insurance as soon as possible, as early in life as possible. We're going to talk about the cash value that's inside your life insurance policy as an asset and talk about a lending system called an insured retirement plan. And then we're going to get a deep dive into the capital dividend account, which is the CDA. And this is a key advantage that Canadian business owners have and should use. We'll also talk about how the capital dividend account helps with the recent capital gains inclusion changes. Then we're going to get into how insurance is something that you can do that has full value right away versus other tax strategies that take time to generate their full value and may never get there. And then we're going to talk about your accountant and who do you choose as your accountant? What is the right accountant to choose? And how we could look at that as your accountant being your financial doctor who could prescribe certain medicines. We're going to get into, towards the end, how life insurance is the last tax shelter these days, especially inside your corporation. And we're going to wrap it up with some advice for a 40-year-old Canadian business owner, what they can do today that your 60-year-old self will thank you for. And so with that, let's get into it. Vince, you've been doing this for a really long time and wanted to talk about just the beginning, just the concept of insurance and like, why is it important to spreading risk? Where does it begin? How did it develop through history?
Yeah. That's an interesting question. Insurance is all about spreading risk. And spreading risk does not necessarily mean just life insurance. There's other types of insurance, as you know. We all insure our car and our house. But spreading risk is a concept that's been around a long time, and it goes back to about 5,000 years ago when people who wanted to transport their goods via ships would spread their cargo over many ships so that if pirates got one ship, they didn't get all of their cargo. You jump forward and you had even some burial clubs in Babylon. So if a member of the community died, it was very expensive to bury someone. So they would collect bits of money before and have the pot of money waiting to help their neighbor bury their deceased. And then you jump forward to, we all know Lloyd's of London. Lloyd's of London was a coffee house where people used to come and protect their goods for shipping, and they'd ensure the safe transport of their goods. And interestingly enough, they got bored when there was no ships leaving ports. So they used to read the social papers of the well-to-do people and start taking bets on when those people would pass away. Just like betting on the date of a baby being born, they used to bet on the day that some socialite would die.
Oh, wow.
And they would collect the pot, and the person would win the pot. Now, that's almost reverse engineering insurance. You want the people who need the money to get the money. And then the most recent, the first life insurance policy sold in North America was in Philadelphia in something like 1781 or something like that. So insurance is the concept of spreading risk has been around a long time. Insurance companies have taken on the task, and it's a huge burden. to have the wealth and collect premiums so that they can pay out the death claims when needed. You can't just insure one person and hope that they die. You need masses of people to pay premiums so that you can build up a pot of gold to pay out the death benefit when needed. So insurance has been around a long time. It serves a very good purpose in our society. Canada is fortunate. We have one of the best run industries in the world when it comes to insurance. The safety nets that exist are second to none. So other countries look to Canada for the safety net that we have to protect Canadians and their wealth.
Cool. And it's one of the pillars of the Canadian economy, with the banks, the trusts,
yes,
investment houses, the insurance firms.
They've almost all come into one now, but yes, it is one of the key pillars in the financial services industry.
Okay. And then we're living in the technological age of insurance in Canada, as technological as it can be. We're still very behind other industries, but when you were there was actually a rate book that you used. And so most people that be watching this probably don't know what a rate book is or how it works. Do you want to give the little 1-minute version of what is that? What is that?
Sure thing. It was like a pocketbook. It was skinny and tall, and it had a spellbound binder so you could flip the pages easily. And it had all the ages of men and women in the book. So if I was in front of someone, you had to have a calculator, and it would give you the cost per thousand. So if the person was buying 100,000, it'd be 100 times the factor there. And it was at a time when the regular rate that you quoted someone was a smoker rate. You got a discount if you were a non-smoker. So a lot of people smoked back then. So I guess they dealt with the law of averages. Most people smoke. Let's put the smoker rate first. You get a discount if you're a non-smoker.
Oh, wow.
So that goes back quite a ways. I'm glad we've come a few degrees since then in terms of technology helping out.
And then at ProMerita, you're on the strategic wealth side of that. The company does a bunch of different things, and then we'll focus on your part of it. How does that kind of fit into what you do and the clients that you work with or their advisors that you work with?
Well, I think our key role is explaining something that is fairly complex in very understandable terms. And people have different nuances and different ways of explaining things. So prior to being at ProMerita, if I go way back to the beginning, I was a trainer at Standard Life. So I trained people across Canada on the new product at the time, which came out in about the mid-90s. Universal Life became very popular then amongst the insurance companies. And I trained the brokers and agents for Standard Life across the country. So to be able to do that, you have to understand the product and to be able to teach people about the product and explain it so that they can explain it to the clients. There are moving parts, as you know, in two permanent products, Universal Life and Whole Life, and being able to explain those in a way that the client or the gatekeeper, I call them the gatekeepers, the accountants, the lawyers, and family offices, if they can understand the product, then they probably buy into the idea of getting insurance for their clients. And if you understand it, you'll own it. You'll own the ownership and the understanding. It'll carry you through your life, which is really good. At ProMerita, I work almost exclusively through those centers of influence: accountants, lawyers, family offices, and existing clients. It's a good place to be. They know I exist, and I'm sort of an extension of their service to their clients. So that makes it easy when I meet a client. I don't have to sell myself or do any promotion. I'm in there to explain how things work and how we can solve the problem that's in front of them. So life insurance is really cash at death. That's the number one reason. So there are many reasons that people need that. If you're a young business owner or a young family, you have a young family, it's to replace the income. Lost income is a key driver for young person insurance. As a person gains wealth, and perhaps business owners start their company with $100, $1 a share, and then the company grows. As you know, in Canada, upon your passing, you dispose of all your assets at fair market value. Unless you have a wife or spouse, you can roll that over tax-free. But when it goes to the next generation, that's when the taxes are due. And so usually there's a huge need for liquidity at that point. So that's mostly the market I work in. How are we going to crack this tax nut that we have in front of us? So we tackle that problem jointly. I like to tell clients, I sit on the same side of the table as you. Our problem is CRA and the tax that's going to be imposed on your estate. So let's try and solve this in the best way we can. So I had helped through accountants, lawyers, and family offices. I do that, and a lot of those COIs happen to be my client because I tend to sound and look like them. So that's very comfortable. So that's basically what I do on a day-to-day basis.
Yeah, so you mentioned that you help them to solve these problems as these business owners, as they grow their wealth, as they want to transition it to the next generation. So one of the problems that you mentioned was the liquidity at death. What are some of the other ones? So like the life insurance creating money on death. This is the number one reason for having it, but what would be like the number 2 or 3 or 4?
Well, that's good. Well, let's start with the basic need, which is income replacement. So when that's key when you've a young person and you have dependents. When you get up into the business market, you're talking about funding a buy-sell. So it's a very simple concept. I'm pretty sure your audience knows all about it. But if you've got partners, chances are their will says everything goes to their spouse. And so if one of the partners passes, you've got a new partner. Right. And that partner is the spouse of one of your working partners. And of course, you can't forget that CRA is probably one of the partners too, because if the shares have grown in value, they're going to get their pound of flesh. So funding a buy-sell is a key reason for insurance for business owners. Another one is a business succession. So suppose you have got everybody that owns the business is not arm's length. They're non-arm's length. They're family members. Mm-hmm. So you've got issues there. You've got the transition of the shares and the control of the company. And when the shares, the value shares transfer, then there's going to be a huge tax liability. But you've also got estate equalization issues. So not everybody's built to run and own a company. And as the business grows and the generations take over, you're starting getting into cousins and distant cousins. So there's estate equalization issues. Somebody's getting the business. What is the other child or children going to get? So there's a funding requirement there. You've also got, of course, the tax liability. So we have things we can do in Canada. Business owners have the luxury of things like estate freezes, where they can cap the amount of the growth on their shares and pass the growth from that point on for the next generation. So usually there you have a fixed tax liability and it's known, but there are ways that you can mitigate the risk of having enough cash to pay the tax liability. So that's another reason. And even there are things in the life insurance world combined with annuities that can actually generate income. So they were very popular a while ago. They're back a little bit now since the rates have gone up a little bit on the annuities. That you can do what's called an insured annuity. I haven't done one in a long time, but they do work again. Those are great pieces of planning that can help the client. I've got one client who we did a fair number of insured annuities simply to protect the spouse from the children asking for too much money.
Okay.
So the patriarch said, I want to do insured annuities because instead of having this bulk of a sum of money, it's going to generate income every month. So the most that the generations after can ask for is what's going to be generated on a monthly basis instead of the big lump sum.
So I guess this is solving the problem of the kids continuously asking the parents for money.
Yeah.
And the parents could say, here you go. This annuity is going to pay you this much every month.
Yes.
Guaranteed for life or for a period of time.
Exactly.
if you spend too much, then that don't call me. You're getting probably, I guess, if they're doing something like this, it's probably a generous amount. Probably more than a lot of people would ever have. And that's an interesting way to.
It's a way to generate income with insurance products.
Yeah, and it's guaranteed.
And it's guaranteed, and it lasts as long as you do, which is a good thing. A lot of people are concerned about running out of money. Life annuities last until you die, so it's good.
Well, that is an interesting way to do it. You can just say, here you go, kid. Here's this annuity.
Yeah.
Call me for Christmas plans, but don't call me for money.
Well, the longest you have to wait is another month, so you should manage your money properly.
Yeah. Well, yeah, and I worked with another lawyer who had... again, some children of very wealthy parents, and the children were receiving an allowance of $50,000 a month and running out of money before the end of the month.
Yeah.
And doing nothing, like just spending.
Yeah.
No job, no nothing, different problems, different people.
Absolutely.
Yeah, different problems.
But you're there to help.
Yeah, for sure. And then our clientele is generally on the way up. They're not giving those life annuities to their kids yet, but probably that will happen. Where do you see what we like to do is to kind of show this is what the future looks like if you keep doing what you're doing, right? So you're successful today, you run a company, you're making $2, $3, $4, $5 million. Your next step is probably 10 to 15, 20. That's going to be a different level of problems, different set of problems. Where do you see the mistakes that people make consistently in these jumping these gaps, and how, knowing it now might help somebody to avoid that, or might even just bring it up for them in advance.
Understood. So I deal with several families that have 4 generations. So just last week, I insured a baby that was 3 months old. Now, that's not my typical market. Why am I insuring a 3-month-old? Because I dealt with the great-grandparents. So I dealt with Generation 1, and Generation 2 are clients, Generation 3 are clients, Generation 4 are clients.
Wow.
There's one thing it's tough to do is to make someone younger. So insurance is always, the cost of permanent insurance is always pegged to the age you are when you step in. So we can't make anybody younger. And chances are your health's not going to improve as you get older. There are cases that it does happen. So there's 2 things we know. We know that you're not going to get younger, and we know you're probably healthier than you'll ever be. So insurance is a good thing to get at that point. What I see the mistake people doing is they're going to say, I like the idea, but I'm going to use all term insurance to start. Now, there are reasons that can work, but I always try and show them what a small layer of permanent insurance would look like as a base, and add the term on top. That combination can make it affordable, but you're at least taking something permanent at the start. So there are cases where young business owners, if they need $2.5 million, I'm just taking that number, perhaps $250,000 or $500,000 is permanent and the rest is term. And there's a case to be made where you can have 2 layers of term.
Right.
You have a layer of term for 10 years, and when that drops off, because you're not going to renew it because the costs will jump too high, then you have another layer that'll carry you to 20 years. And then by year 21, possibly, it's all gone, all the term, but the perm has grown. The permanent insurance has grown to replace the term, and chances are you have a different need. The numbers are different, and you have the option all along the way to convert some of the term, because it's usually R&C, renewable and convertible, where you can take some more on the permanent side at an older age, so it'll cost you a little more than the first one, but at least you're in a position where you could afford it now because you've had some success.
Well, and you're guaranteed to get it if you ask for it.
Exactly.
You don't have to do the medical again.
There's no medical again. So there are things that we can do to make it. I try and convince people that there's an old saying in our industry: the best time to buy permanent insurance is always yesterday. Right. So if you can do it from the start, at least some of it, then they'll get a feel for it and understand how it grows. And getting the statement is always a nice thing because you see that the insurance is growing and you haven't had to do anything to get it. So it's a good place to be. That's one mistake. Another mistake is just not getting insurance at all because they don't believe in insurance. Right. Now, there are reasons people could think that way. They either have had a bad experience with insurance, and people have always said in this industry, insurance is sold, not bought. Right. Meaning that some pushy person has told you to buy this, and you don't like it or you don't think you'll need it. With time, people who have purchased insurance realize the value, and they want more, or they want to keep it longer if it's term. So there are good reasons to do some planning early, especially if you've got a situation where you have an asset growing like a company.
Right. And then there it'd be really about covering up the risk on, say, passing away and your partner becomes partners with your spouse, or on death, there's going to be a big tax that's due that your estate is going to have to pay, your annuities is going to have to pay. And it's nice to have a check right there.
It sure is.
Quickly, within a couple of weeks, usually, that doesn't have to go through probate, doesn't have to wait a couple of years to get unlocked.
Correct.
That can then be distributed however you want.
Yes. I've delivered some checks to families, and no one ever complains that it's too big or too much.
Right.
So that's why we're there. We're there to solve and do what we say we're going to do. When the need comes, insurance will be there. So that's why we are. That's why we have clients. That's why we work with people. We want to protect them. I view insurance as a defense mechanism.
Yes.
So it's all defense in my mind. Risk mitigation. Let's look at the risks. Let's try and check them off. The world today is people are turning insurance into an offensive product. I want it to do this while I'm alive. I want it to do that while I'm alive. And there are good reasons to do that. And they exist. In the right situation, they work. I just want people to be aware that it's not always necessary. There are other avenues to solve that problem without using insurance. But insurance has become something that is a very powerful vehicle in Canada. We are very fortunate. We have an income tax act that gives life insurance, permanent life insurance, tax benefits that no other product has. Let's not poke the CRA bear by doing something too aggressive.
Right.
I've been around a long time. I've lived through the vanishing premium class action suit. I've been through the 10-8 fiasco. I've had to clean up some messes in those areas for families who say the person who gave me this or sold me this is long gone. They not in the industry anymore. So that's all pro bono. I don't get paid for doing that.
Right.
But I do it because I'm trying to trying to do the industry a favor.
You want to make it right.
Sometimes we have a bad reputation out in the street. If we do more of these good deeds, I'm sure it'll help.
And then we're talking about defense and offense here. So on the defense, generally people understand insurance as defensive. On the offense, what would be some things to look for? Like what would be an offensive type of play with an
offense? Not offensive, but on offense. I understand it's a play on words. Cash value in an insurance policy is an asset, either in your personal balance sheet or in a corporate balance sheet.
Yeah.
And it's sedentary. It's sitting there. It's in a tax sheltered environment. So people are looking at ways can I access that cash while I'm alive? There are reasons I might need it, and it's not generating income or generating leverage or collateral for a loan that I might need. So banks are willing to lend off the cash value, both early in a policy's life and at the end. If you've built up the cash value, this could be a type of pension plan, right? For especially professionals, doctors, dentists, these people who are incorporated. They usually have a practice that's incorporated and a good place to put their insurances in there. And if you build up cash value when it flips, when you retire, and it's just a holding company, it's not operating anymore, you can use the cash value inside the insurance policy as collateral, and they will create a series of loans to replicate a pension.
Yeah,
it's a very safe use of the cash value in an insurance policy. Of course, the bank is in to make money, so they're going to charge you interest. And if you don't pay back the loan in your lifetime, they'll take the loan, that outstanding loan, from the death benefit when you pass away. So there are ways to use insurance while you're still alive, and there are safe ways to do it. And there's a couple of aggressive strategies out there. I just hope that the people who promote these aggressive strategies are there to clean up the pieces if something falls apart.
Right.
So pick the right insurance broker.
Definitely. Yeah, I agree with you that it's good enough that you don't need to. You don't need to do more.
No, exactly.
And there's other
stands by itself.
There's other things that can do those mores.
Absolutely.
If you want to take those risks, like we use the phrase when we deal with clients is that insurance is there to take risk away, not to add risk. So
correct.
Yeah, and then I guess the type of loaning that you're talking about, this would be like an insured retirement plan.
Yes.
This is what the banks would call it as their loan types.
For sure.
Yeah.
For sure. The cash value can be used in your lifetime. You built it up. You own it. You can use it in certain circumstances.
Right. Okay. And then with working with your clientele, this is a question that actually we ask a lot of our clients is we want to talk about retirement, right? When you're making financial plans, retirement is obviously something that people think about. Do business owners retire? And what does that look like, right? And because we have a lot, they say, yeah, technically I would like to, but I probably never will.
Right.
I'll always be doing something.
Correct. So it depends on if it's a arm's length type of company where you're dealing with people who are not related to you, and or there's the ability to sell the company at one point. There's going to be a liquidation of the company, and then of course there's the business owner who never relinquishes control, and they're going to maintain ownership till the end or control till the end. Life insurance is a good asset to have in all three of those situations, because if you structure it properly, you may need the insurance to serve a certain purpose when you're building your wealth, and it can transition into something that can protect your wealth when you're getting older and on in life, and you've got something to protect. Usually the business is if it's grown, if you've been successful, there's going to be a tax liability somewhere along the line. With some planning, with the use of trusts and life insurance and holding companies, you've got a lot of avenues here in Canada to be able to use life insurance to solve more than just one problem. Corporate-owned life insurance in Canada has a benefit that does not even exist in the U.S., which is the capital dividend account.
Okay.
So the capital dividend account is those dividends that can come out of a company tax-free. And life insurance is a capital dividend account creator, right? Generator. So a lot of the planning we do is to be able to use corporate funds to pay for the insurance with after-tax corporate dollars. It's non-tax deductible. It grows tax sheltered. There's no tax to be paid on any of the growth of the cash value. And it can largely, if not all, come out of the company tax-free at the other end through the capital dividend account. I mean, let's make hay while the sun shines. The government's the CRA's letting us do this. It goes to the beginning of Canada, when our prime minister was also the president of Manulife at the same time, before a conflict of interest existed. Mm-hmm. So if we're blessed with those generous tax rules, let's preserve them and use them. It's all good under the sun. So let's use those, take advantage of them. And I've seen it work. I've delivered those checks through the capital dividend account, and the surviving shareholders or the surviving family members or the business partner is able to use those to actually serve the purpose that insurance was put in place for.
All right. And then, so on that capital dividend account, I guess for a lot of people may know what that is without actually even really knowing what it is. It's also, life insurance pays out and creates the capital dividend account. The other part that most people would know is it's the part that's not taxed when you have a capital gain. So part of your, like if you bought a stock and it went from here to here, 66% of that is included now. The rest, the other 33, is a capital dividend that's not taxed, right? So life insurance does the same thing, but without the 66-33 split, you get the whole thing over a period of time, depending on what your adjusted cost basis is.
Yes.
So yeah, and where would you see, so on that same kind of vein of having it in the business and having the capital dividend account pay out or the CDA pay out to your beneficiaries, where would you see somebody doing it right, and then on the other side, the mistakes or somebody doing wrong? Like, how do you make sure that you get the most out of it, and then how do you make sure that you don't mess it up?
It's a case-by-case basis, and I don't make that decision and analysis alone. I do it with the accountant.
Okay.
And or the lawyer. No, never the lawyer by themselves. The accountant, maybe the family office. We work through scenarios to maximize the capital dividend account, and there are ways to do that.
Okay.
You have to go through an iterative process. It's not a slam dunk each time. And, the CRA has really visited our industry twice. 1982, following the McKicken budget. And on January 1st, 2017, they effected changes to the Income Tax Act for insurance. Since that date, the calculations have changed. The rules have changed inside the insurance company that calculate the CDA. It used to be more favorable. It's less favorable now, so you have to look at that when doing it. It's a formula that is not easy to understand. What creates the CDA? It's, as you said, it's the death benefit minus the adjusted cost basis of the policy. And the ACB changes. It has a mountainous view. It goes up to a peak and comes down. But unfortunately, with the new calculation at the much older ages of insuring someone, the ACB never goes to zero. So there's always some CDA grind, ACB grind in the death benefit. But our plan is to show how we can maximize that. And truth be told, it changes case by case, depending on the age, the gender, whether it's a single aged person or a joint last to die policy.
Right.
So that's what we get. That's what we're brought in to do, is to maximize the after-tax benefit.
Right. And I guess to get the adjusted cost base as close to zero as possible, the number one thing you can do is have a lot of time. So
yes,
setting up the policies as far in advance as possible, and not, you definitely don't want to set one of these things up today to get the benefit tomorrow. It's, you want to set these things up 15, 20, 25, 30, 35 years in advance.
Good point.
So that the ACB has the time to get to as close to zero as possible, if it's not all the way to zero.
Very good point. The earlier you start, the earlier the ACB will get to zero. So that's the biggest benefit.
Okay. And then what do people do wrong? What's like, have you seen, and you've seen a lot of cases. So like if you anonymize a case and say, well, this was not the right thing to do, how does that look?
That's a good one. Without sounding too arrogant, none of the recommendations that I've given and people have accepted has turned into a bad situation.
Okay.
It's usually when they don't take someone's advice, either mine or someone else's, or they think they can do it on their own.
Oh, okay.
So occasionally you'll meet the accountants, lawyers, and family office people who say, we can plan this tax liability away. A classic example is a wasting freeze. So a freeze is when you exchange your common for preferred shares at a fixed value, and you have now your tax liability, and the idea is to waste the freeze. In other words, have the company buy back the frozen preferred shares to create income as a retirement for the shareholder who's given up control. The problem with that is you have to have certain things, refundable tax and other things in place to be able to make financial sense. Or the person simply is making too much money in other areas. So why am I going to generate more income that I can't use at a higher tax rate? So the freeze gets delayed, the wasting freeze.
Right.
So then you've got a big tax liability, and nobody knows, when their number's going to come up. So sometimes you're a quarter through the wasting freeze and an event happens, and now we've got taxes to pay.
Right.
So insurance is full value from day one. So that's what people need to understand. Sure, there's a cost for insurance. It's not free, because if something happened to you next week, it pays out. Nothing else will do that. You start some sinking fund as an alternative, you're never going to get there until way down the road. Things happen between now and then, and life changes. Your cash flow changes. Your marital situation can change. Your business situation can change. You can have a falling out or take on new partners. Life has its curveballs. Life insurance from day one has been the safety net to protect all those situations. So making errors is probably not heeding everybody's advice in terms of you should do this, you should consider this for protecting the value that you've built up already.
Okay. And then on this, so heeding advice of professionals. So we've talked about, you as the insurance advisor, there's lawyers, there's accountants, there's the family office. Maybe most people don't have a family office, but how would you, what we call it your financial team.
Right.
When we talk to somebody and we want to know like who else is on your team, what does a good team look like? Like what if, say I'm a business owner and I'm, in my 40s, I've got young kids, business is doing a few $1 million, I'm making a few $100,000. What should my team look like? Like who do I look for? Because I don't know. School doesn't tell me have a good bookkeeper, have a good accountant, have a good.
Agreed. It's a tough one. I always start with the accountant. The accountant is, to me, the financial doctor, the person who is the gatekeeper and tell you to take this medicine or not, or take that medicine. So the accountant really holds the trump card. Getting the accountant to understand and actually recommend insurance is the hard part.
Yes.
You have accountants, all accountants are humans, and every human has a different viewpoint on financial products. So getting them to understand and buy into what life insurance can do is the first step. If the client themselves has an idea that they may need this product, that would be helpful in convincing the accountant if the accountant is not on side. Lawyers usually want to know what's happening because they are going to be structuring the will, the power of attorney, and possibly where the shares are going to go. And insurance is a helpful tool for them. But they understand it on a different level than the accountants. The accountants are numbers people. And that's where I get along with accountants. If accountants, I'm a numbers person.
Okay.
I crunch the numbers and I go through it, and the accountant gets it. Sometimes the lawyer does. Sometimes they don't need to know it or want to know it. And so that is their team. They usually have one of each, anyways. The family office, as you said, is only for families that have a great deal of wealth. They are becoming a very important aspect of our financial services industry. In case people don't know what a family office is, it's the team that a wealthy family will hire to be the go-between between the accountants, the banker, the real estate person, the insurance person, all of these people. They are the gatekeepers. You speak to them first, and then if it makes sense, they'll introduce me to you, and we'll talk about it. So they have become very important in our industry. As you know, unfortunately, there's a widening gap between people of wealth and the middle class is disappearing. So as you know, we're needed at both ends of the scale. But if you have the opportunity to help a family office, you will. I work through several family offices where I am called in to explain something. It's a good place to be. I don't usually do any planning. I have a CFP, but I don't plan. I am brought in simply to be an expert in this one thin area called insurance planning. It's a very slender part of the Income Tax Act. To be an expert in that one chapter is very valuable for them because it's the last tax shelter left in Canada for corporations. Let's just say it like it is. Is there anything else that lets you go corporate money tax-free and largely come out tax-free? It's the last game in town. So it's very valuable. People are realizing the value of it. As income tax rates go up, it's more and more. It's more. What's the word I'm looking for?
More valuable.
More valuable. It's
It's more in demand too.
It's more in demand. The insurance companies are changed quite a bit, and they're making it easier to get life insurance. You don't have to go through the medical tests at up to $5 million now, and so it's a good product to have. It makes sense. Financial, the internal rate of return, which a lot of people are concerned about. What is the IRR in this? How good of a financial product is it compared to the alternatives? It usually wins the game if on an after-tax basis, if the person is healthy. If they're not healthy, then it becomes a little more of a calculation, more of a challenge. But it's the planning tool of choice for people who want to protect their wealth.
Okay. And so we were talking about accountants, right? So same with any industry. You know, our industry, I think there's 90,000 insurance advisors across Canada. Accountants, I imagine there's tens of thousands or hundreds of thousands of them across Canada. Out of those many, many thousands, some will be better than others. So if I'm that business owner, how do I know if I'm working with the right accountant, or how do I know what to look for? Because you know, like we've had to upgrade some of our clients' accountants, where they come to us and they're like, well, this is my accountant, and then we talk to that person and we're like, these shouldn't be your accountant. You need to move up a level here.
Yeah, they've outgrown the accountant and their services. I see that, and I introduce them to another accountant just to see if there's a match. They can work together. Not all accountants want to work with every type of company. There are industries that they favor. So I do recognize that. I happen to have a lot of clients that are tax accountants. So just like they have favorite people that they like to work with, I have favorite people I like to work with. I like to, you know what? I tend to think that people like attracts like.
Right.
In other words, people who view life and tax and wealth and everything, if similar to yours, you'll probably get along. And it doesn't take long to recognize whether someone has the same value system than you, either accountants, lawyers, or whatever. Getting to know them is the tough part.
Right.
Getting to know them well enough. And that usually takes either a case where you're working on a joint case, or you get to know them through some association or some activity that you have. So I belong to several associations, and I get to, a lot of them have accountants and lawyers in them. So they're seeing me constantly. I'm asking, is there any way I can help? Or largely I get to know them through presentations.
Right.
I'll offer a presentation, and I say to them, would your tax team enjoy a refresh on where insurance sits today and what it looks and acts like? And they go, yeah, we haven't had one in a while. So I'll get in and I'll talk, and I will let them drive the bus. What I mean by that is I will talk about a product. I will draw a product on a whiteboard. and I'll say, let's take someone in the room and let's shop this product for.
Let's do it for you.
Let's do it for you. And they go, oh, I didn't know that. And I said, here are your options. Here are you good, and here's what you got to be careful of. And then I'll go up to this next level, and I'll show the next product. And I'll say, let's do the same person. And I'll show them exactly how it works. And I'll say, here's my screen. Here's my input screen. Let's choose what you like and what you don't like in there. And then we'll go to the last product, the third one, which is probably usually whole life. And I'll say, let's look at this product. Let's look at the pros and cons. And I don't hide the issues, the cons for life insurance. There's flexibility of premium, things like that come into play that I don't want it to be a surprise.
Right.
So I tell them right up front. And I explain it from the insurance company standpoint as well. I let them be the underwriter. I say, okay, now let's suppose you ride your bike. Okay, is that a big risk? No, it isn't. You fly your own plane. Is that a big risk? It's different.
Different.
Exactly. And there's only 4 ways to deal with risk. You can accept it, you can transfer it, you can reduce it, and you can transfer it. Life insurance is a risk transfer mechanism.
Right.
The risk of financial loss. So if I show it to them and I explain it to them and we number it, they go, I get it. I understand it now. And once you understand it, you can own it. You can say, I can make the decisions. An informed decision is where you want to bring the client to so that they can make the right one based on their own value system. Getting them there takes a bit of work.
Yeah.
So I've been at it a long time. It takes time. Be patient. You're in it for the long haul. This is a long game. It's not a quick fix, as most things of value aren't. Take your time, do it right. And the issue being with young people, sometimes you have to go back. Insurance may not be the one and only time done.
Yes.
For the older set, 55 plus, chances are you're going to do this once. If you do it twice, either something's gone really bad or really good. And so you need to revisit because the inclusion rate has gone up. Now your tax liability has increased by 10 million, which happened to one of my clients, just from the inclusion rate. So how do you do that? You didn't know that was coming. I did not know that was coming.
Yeah, nobody knew.
Nobody knew. So can we address it? Does it make sense? So we're revisiting that issue right now with the clients.
Okay. On that note of revisiting, how often are you revisiting with clients, and how often, like, if, again, not me as an advisor, say I'm me as a business owner, how often should my advisor be reaching out to me, or how often should I be meeting with him or her? And what do we talk about?
Okay.
Hey, if you already did it.
Yeah.
What do we talk about next time?
It depends on your client makeup, and it depends on the product that's in place. So let's go through the gamut. There's not that many. Term has no moving parts. If you touch base with the client once a year and say, here's where your term is, here's when it renews, here's what the price will go to, chances are they're gonna be aware of that. And so there's always something at the bottom of your annual review that says, reach out to me if you have any questions. When you get to Universal Life, it's the product on the re-engineering team that I helped design. I actually don't do very much Universal Life. It was created for a purpose, which was I want to control more of my insurance policy than is what is allowed out there. So the insurance companies had a reaction. They said, oh, you want flexibility? We'll give you flexibility, but with flexibility comes responsibility.
Yeah.
You're going to be responsible for the choosing of the investment and the returns. And there are pricing mechanisms behind Universal Life that I don't want to share with your audience, but I know them.
Yeah.
I was there. And it's tough to make money on the money side of the Universal Life because of the things that are in place. So that has a lot of moving parts and needs to be looked at quickly, often.
Yeah.
Now, whether that's quarterly, it's up to the client and what their investment mix is. And then you move to whole life. So whole life has a lot of moving parts, but you can't access them. It's the black box.
Right.
Everything's happening behind a black box. The client has to trust the advisor and the insurance company that they're doing the right thing on their behalf. So you have experts managing the investment. You don't see the investment. You can't look at it on your screen. It doesn't do anything during the year. It's just accumulating as an investment. And once a year, you're going to get a reaction or a dividend from the performance of the par fund. And that's when everything takes place. On the anniversary, there's a whole bunch of moving parts. So with that, usually I follow up with the client after the statement has come out and they see the difference. They see the growth and ask them if they have any questions. So it depends on the client. It depends on the product that's in place, and it depends the style of communication. A lot of the business owners that I have as clients have become friends. So I'm seeing them all the time in social events, or other ones I don't see very often. It's just the way it is. They don't need to see me. They don't ask questions, and they're happy with the performance. So we leave it be.
Yeah. We actually, you mentioned too that we're lucky in Canada to be able to have this type of insurance. I know whole life insurance has gone away in a lot of countries. A lot of countries never even started it. So we are one of the few that has this. And you're talking about that black box, and you kind of have to trust it. But there's also a track record there of, most of the companies that we deal with are 100 years plus of paying dividends every single year. And, like Sun Life, Canada Life have never not paid a dividend ever.
Correct.
And for longer than Canada has existed.
Right.
So there's an element of trust that's there. Obviously, you can't promise that they're going to pay a dividend in the future, but you can say that they did for more than 100 years, and the product is designed around it. So if they didn't, something really catastrophic has happened.
Yes.
For that to happen,
Yes.
And there's probably other problems that you need to worry about.
Yes.
If that's the case. One story, actually, just from a client of ours, I do remember going into their house. This is before COVID, when we still used to meet people in person. Now everybody's on Zoom. But, he said, I love it when Laurent and Rob come over because I never lose money.
Yes.
And he was, he liked to invest in a lot of different things. And some of them could be called schemes. But then, when we came in, he's like, I love when you guys come because these whole life policies that I bought 10 years ago or however long ago it's been, he's like, they just keep chugging along. Yeah, they're not doing anything spectacular, but they don't go down, and they never say zero.
Correct.
And they never say negative, which is great.
That is good because it's the only product that allowed to smooth the returns.
Yeah.
And average out the returns over the years. So
when it's vested immediately. Yeah. Right.
Well, when you receive the dividends vested, but inside the fund, they can take the great years and save them for bad years. So the dividend is smooth, which is a really good mechanism to have in insurance. That brings about a different conversation about the sequence of returns is more important than the average return.
Yeah.
And so with whole life, the sequence of returns is actually smooth. So that helps you a lot better than just negative returns once in a while.
Yeah, 100%. Yeah. And when you're looking online, I find a lot of people just talk about average returns, right? And then it's whenever you're reading anything financial online, the solution to everything is always an S&P ETF low fee because it's a 9% average return over time. But what that doesn't say is that, 1 year it was 25 up and the other year it was 30 down.
Yes.
And then the next year it was 15 up and then the other year it was 40 down. And you're like, well, if you're catching it on a good year, that's great. If you're catching it on a bad year, that's not great. But technically over time, it adds up to 9. And it just, your sequence of returns there is way more important than the average.
Absolutely. And not only the sequence of returns, but you must remember that life insurance, life insurance costs money.
Yeah.
So where does the insurance company take the money to pay for your cost of insurance? It comes from the investment that you have inside the policy. So the worst time to take money out of an investment is when it's going down. Right. So if the market's going down and you haven't got smooth returns and they're taking the cost of insurance out, if you start at $1 and you lose 7%, you're down to 93 cents. If they take the nickel out to pay for your insurance, you're down to below 88. It takes a lot more than 7% to get back to $1.
Right.
So that mechanism over and over and over again of pluses and minuses can affect your overall performance of the policy in a great way. So if you don't mind me sharing, I ate my own cooking. I bought 2 of my own perspective policies that I helped create, and it took me 14 years to make a positive return on one of my policies because of 2008. So when the market went down, I lost a lot of money, plus the cost of insurance was coming out. So it took me a long time to make a positive return on my universal life. Yeah. So that's a humbling experience. I'm sharing something personal. I'm able to do it because it's my policy. It's not up to clients. So that is something to be aware of. Now, there are other good uses for universal life. Don't get me wrong. When you get into the much older ages, you just can't make whole life work as well as universal life.
Right.
You can't catch up fast enough for the dollar that you're going to pay on insurance. You're probably better off buying universal life when you're in your mid-70s or something. It makes more sense than whole life. So,
yeah, we also eat our own cooking too. I have multiple policies. Rob's got multiple policies, corporate policies, personal policies, kids policies, for sure spousal policies. We have all the versions, and probably will get more over time.
Yeah. Well, I oddly enough, I have a lot of babies as clients. And
just generationally.
Just generationally. I'm not going to say no. These are the families I've known for a long time, and I take care of all their issues. And I know a couple of accountants that really promote you should insure your kids, because there's a period in time, lots of time, when kids are teenagers that they might be uninsurable. They're doing things that a little wonky,
right? And
getting through the underwriting might be difficult. If you start them at an early age, it just sings. So
nobody's introduced them to anything yet.
Exactly.
All right. And then just we're getting to time. But this has been great. Actually, it doesn't really feel like it. But what can somebody do right now as a 40-year-old business owner with their family here in Canada to set themselves up so when they're 60? They can look back and say, thank you, 40-year-old me, for doing this, because now I'm in a great place.
Well, if they have additional cash flow or excess cash, there's nothing stopping you from having a corporate-owned insurance policy and putting extra money in so that you don't have to pay forever. Nobody wants to be paying for insurance in their 70s and 80s.
Right.
So how can we avoid that? We can avoid that by overfunding a policy. And lo and behold, the Income Tax Act has a very lenient window for overfunding an insurance policy. In other words, putting money in the tax-sheltered cash portion and letting that, plus the dividends, pay for future premiums. So you can take your foot off the gas and have it not come out of your pocket. So I would recommend doing that. If you can't do it all with permanent insurance, do that combo. Do that permanent plus term. It'll get you to the insurance level that you need today in case something happened. And over time, when you drop the term off, your whole life will have grown up to the level that may solve your state tax liabilities or create a pension for you down the road. So that's the safe way of doing it. If you have a business and you really can't afford to give up some cash flow or capital for your corporation, there is a mechanism to have your cake and eat it too, so to speak, where you can leverage up front off the policy. I really like the safe approach there, where someone, if they're going to do that, maybe pay the first 2 years out of pocket and then build up the cash value to a level where by year 3 or 4, you can actually borrow the full premium back without having to provide additional collateral. I like that. It's a safe way of doing the aggressive upfront leveraging strategy.
This would be an immediate financing
arrangement, but don't go full bore from start. That's just my it's my style.
Yeah, we generally tell people too. Yes, you technically could do this, but let's let the seed grow a little bit before you harvest it.
I like that.
Right. You don't plant it and cut it down tomorrow.
Right.
Plant it, let it grow, and then cut it down.
Now, everybody has their own style. Everybody wants to build their business in a different way. I've been fortunate to see other people make mistakes with those two strategies that basically got shut down, which is the vanishing premium and the 10-8. So I said, I want to avoid those. And I actually stood on a mountaintop and told accountants and lawyers, do not let your clients go anywhere near 10.8, and they didn't. But those 10.8s evolved into bad IFAs now. So I'm fixing up problems to this day. I also donate my time. So that's something that people should do if they want to build their practice.
Okay.
And so I volunteer. I vet a lot of insurance policies for some of the large charities. So I've been on their board or their committees, and I volunteer my insurance expertise to vet all the insurance policies that have been donated or about to be donated. And so I do presentations there as well. And I was on the executive of the Estate Planning Council of Vancouver. These are things that people should consider doing to be out there, build your reputation. A lifetime of good deeds can be undone by one bad deed.
Right.
So avoid doing that bad deed. Avoid doing something aggressive that you wouldn't do yourself. Your client will thank you for it one day, and you will be able to stay in the industry. So I'm helping a lot of people entering the industry right now. I'm mentoring some people, and I have many young people come and ask me for advice. What should they do? What can they do? They want to do joint meetings with me. I guess it's my way of giving back. But I'm not done yet. I'm enjoying myself, and people who know me say, oh, you're going to be in it for a lot longer, and I think I will. I enjoy it a lot, and my clients have become friends, a lot of them. And so it's fun. It's fun. I'm here with you today. Thank you for inviting me to join you. This has been, I've done a lot of the talking, of course.
That's the plan.
That's the plan. And there's always collaborative opportunities, and maybe they'll come from this podcast. I'm willing to help out when I can.
Cool. We really appreciate it.
Okay. You're very welcome.
So Vince, I really want to thank you for your time today and for sharing your, deep wisdom and expertise, and even just showing our clients kind of what does the future look like if they keep doing what they're doing. Some of the things that they can do today that'll help them into the future, and even just getting into we don't normally do this on the podcast, but we really kind of got into the weeds of how insurance works underneath, and why that value is there, and why it's special in Canada. I don't think a lot of Canadians really understand that what we can do with life insurance in Canada, most people in the world can't do. And it's actually been taken away in certain other countries, right? You used to be able to do this in the UK, you used to be able to do this in Australia, and now you can't anymore because those types of policies are gone. They've been legislated away. So I do agree with you that we should, while we have it, make use of it, and defend it and use it properly. But yeah, I definitely wanted to thank you for your time, and happy to, if anybody wants to get in contact with Vince, we'll leave the information below. You can connect with us, and we talk to him. So we'll connect everybody either via email or phone or in person, however you guys want to do it. And that'll be wrapping it up for us today. If you have any questions or comments, leave them down below. We check those all the time, and we'll be happy to answer the ones that we can answer publicly. If it's something that's a little too complex, maybe don't share any personal information or any numbers, and then we can answer those offline if that's something that you wanted to do. Before you go, if you want more people to see more content like this, if you want us to create more content like this, then show the algorithm, show the robots that this is what you want to see. And the way that you do that is by clicking on the like button. You click and add a comment, you click on the share button. If you click and interact with all the buttons that YouTube tries to make you click, that helps this show up higher on the feed. And maybe we'll be up higher than, dancing bears or kids getting knocked off bicycles or something like that. But that's it for today. I'll see you next time.